You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for a little program I like to call around these parts Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs, 15 to be precise, for you guys to enjoy on our network, including many great archived episodes and debates and discussions and guests on this fine program, Volatility Views, stretching back many, many years. Where can you find all of those great archives and discussions and debates, of course, as well as all of the other programs on our network? Well, of course, theoptionsinsider.com, the easiest place to do that, or just grab our network feed via iTunes or TuneIn or Stitcher, wherever you like to get your favorite podcast. And if that's all too much for you, of course, just grab our mobile app, iOS, Android, and the beloved Fire OS, or search for Options Insider Radio Network. I know it's a mouthful, but you have to be very precise in those app store searches. They're all pretty terrible. And of course, you can always join us live, noon Central, 1 p.m. Eastern, via Mixlr, MIXLR. Just follow us there on social media. We always tweet out the link so you can just join it and join along in the chat room, listen live to the program, ask questions, and see how the sausage is made in real time. No matter how you listen, it could be live, could be after the fact on the podcast, however you get it, make sure you hit us up with your questions, your comments. We love to hear from you guys at the end of the day. And joining me on the old program today, let's go in order of proximity. Let's start off. I definitely know he's closer this time because I know one of you is not even in the same time zone. So let's start over. I think you're in scenic Riverside, or maybe perhaps you are in the downtown HQ of Option Pit. Either way, we are joined by the Greasy Meatball himself, Mr. Mark Sebastian from OptionPit.com by way of Carmen Line Capital. Mr. Greasy Meatball, welcome back to the program. And where are you today? Where art the meatball today?
I am in downtown Chicago at our world headquarters at 190 South LaSalle. Where's my music today, Mark? My new awesome intro music.
I never guaranteed that for every show. I gave you a sampling yesterday on the option block. Maybe a little bit blue for the Volatility Views program. We got to tweak it a little bit for this audience. But it was a fun one. Check it out on yesterday's option block program if you did miss it. And speaking of a man who has his own theme music, I believe we are also joined now from the Volatility Mecca, formerly of Poland, now of London, Mr. Russell Rhodes himself, the actually now corner office man over there at CBOE and the head of education over there at the Options Institute. Mr. Rhodes, welcome to the program. And where are you beaming in from? Are you beaming in from glorious Warsaw or London or somewhere else in between? Where are you?
I'm in London. I landed at 11:15 your time and made it to the hotel room just for this.
It's very
amazing,
impressive,
huh?
Very impressive.
People can't, how do I sound? Because we didn't get to do a sound check, and I'm using an alternate form of communication.
I'm being told to turn you up, so I'm doing that right now. I think you sound pretty good, all things considered, sir. That you're beaming in from many time zones away, and that you're probably jet lagged, and of course your brain is swimming with volatility because you spent the other day in the volatility mecca that is Poland. So they send you
some vol over there, man.
They send you to all the volatility hotspots: Kamloops, Poland, Oklahoma. You're really hitting them all. 1, 2, 3 on my top 5 volatility hotspots list. So well done, sir. I mean, if it's not a national park in British Columbia, I don't know where you go to get your volatility information. And speaking of getting our volatility information, we have a good guest to help us do just that. So let's get right into our volatility viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody. That music means it's time for our Volatility Viewpoint segment. We are joined in the studio by a great guest. He is a newcomer to the program and indeed to the network. He is Michael Menslage. He is the managing director over there at Exchange Capital Resources. Michael, welcome to the studio and indeed to the Volatility Views program, sir.
Thank you very much, and thank you for hosting me today. It's an honor.
Let's start off, as we do with all of our first-timers here on the program and indeed on the network. Give us a little bit of an overview of your background in the options and derivatives markets and how you found your way over there to Exchange Capital Resources.
Well, first, is there any hazing or anything like that?
There's no hazing. We don't haze our guests. It's only when they're regulars here, like Russell and Mark, they get a little bit of hazing and maybe a derogatory nickname or two. But other than that, you're safe.
Okay, thank you very much. Actually, I got into the options industry right at the peak in 2000. I was very lucky to enter in with Charles Schwab and Tony Saliba's Saliba Capital, Saliba Trading, to get involved in their operations at the CBOE desk, right on the floor, and was very lucky to get involved in that. And I got right away into technology. And unfortunately, after September 11th, I was actually I was an officer in the military, and I was sent to New York for a little while. And by the time I got back, Charles Schwab decided to sell off all their desks and sell all their order flow to Goldman Sachs. So I did a little time over at the Board of Trade and came back and worked for risk management systems, very much like Live Vol Pro. I'm actually quite impressed with that system. A little plug there for LiveVol. And we got involved with some market makers and DPMs, which was a specialist post at the CBOE. But I'll be honest with you, my expertise and my interest and passion has always been indexes. And what we did is as we looked at technology and smoothing the vol curve and a lot of different ways to understand values and look at risk, I saw there was a huge gap between the equity traders on the CBOE floor and the actual index traders. And I really kind of looked at that gap and tried to exploit it for many times, for many years. And we did significant research in that space with the people that I worked for. They were quite extensive. They were pretty involved at the CBOE, both as traders and also in management or in the various committees. And we were very lucky to have the exposure that we did. Unfortunately, things started to change. I decided to go to New York and work for a bank, a French bank in New York. And I was there for just a little over a year. And I came back and worked for a now defunct proprietary trading firm that had quite an extensive footprint in both options and in futures, and that was Buttonwood Group Trading. And unfortunately, that group, we had a little bit of a rogue trader, and we went under. And so I ended up working for a Hong Kong family fund for a while. And I got back and I realized that my roots were always in options and always in volatility. So I decided to move over to VolSurface Capital, which has now been morphed into Exchange Capital Resources at the moment. So I've been in this business now for a good 15 years.
So let's get into that a little bit. You kind of mentioned the volatility curve and the volatility surface. Obviously, the previous name of your firm was VolSurface Capital, so you clearly have a keen interest in that area of the volatility space. But explain to our listeners exactly what it is you guys do over there at Exchange Capital Resources.
Well, we look at the volatility index and the SPX to be honest with you, as an institutional-only product. It is something that the largest of the largest institutions actually use. And we saw that there was a bifurcation of high-end, really net worth, big balance sheet companies delving into the SPX, and then it jumped the gap between that and high net worth individuals. And we realized that there was second and third tier level financial institutions, money management firms that really should be using the SPX as an institutional product. And so what we were able to do is we were actually taking money from different, whether it was from family offices, from various institutions around the globe, and just having them give them exposure into understanding volatility as an asset class. And we were realizing we were spending more time, not so much on trading, but actually getting institutional buy-in from a lot of these big corporations. Because once you're into these bigger financial institutions, you're dealing with a credit committee, you're dealing with a risk committee, you're dealing with a lot more politics, if you will, to understanding and embracing the idea of using volatility, and it's institutional. The SPX is the global benchmark for equities, and the derivative of that is volatility, and it is one of the most important instruments, beta hedging instruments currently, I think, there's a lot, and we do a lot of research academically and talk to a lot of participants in there. And what we tell people is we meet the rubber. Exchange Capital Resources is where the rubber meets the road between academia and a lot of these volatility studies and actually working in the marketplace and hedging your actual risk.
So you're kind of out there preaching the gospel of options and or volatility, if you will, kind of fighting the good fight. Because you're right, there are a lot of funds. We see this at a lot of events. The RMC conference is coming up. That's a frequent refrain at that event of how come more funds and pension funds, et cetera, aren't using these products. And so there does need to be a lot of education and hand-holding, showing how these people, how a covered call and a short put are the same thing, explaining the volatility surface and things like that. So you guys are out there fighting a lot of that good fight. Is that what you're saying?
Absolutely. And we're getting a lot of traction. And especially at the C-level, at the corporate level executives, is just really trying to sit down with them one-on-one and telling them that this is a viable product. The VIX has been around for over 10 years. It has a great track record. It was a shining beacon of efficiency during the global financial crisis. And what we want to do is highlight that. That is a big proponent to that. And when we kind of preface it that as a successful product in times of stress, we're getting a lot of traction. But at the same time, then that's where the buy-in comes in, is really sitting down with the quants, with different risk people, and actually showing them. And sometimes that involves technology. And we're working with some new financial technologies, companies, just to showcase data much easier than it has been in the past.
You know, so you're out there, like I said, fighting the good fight, talking to the various funds and institutions about using volatility in these products. Are there particular strategies that you're advocating? Are you going out there saying, hey, you should buy an SPX put or VIX call or VIX futures? Or is it kind of a mix and match depending on the client? Or what are you guys out there actually telling them about the product?
Well, there's definitely various channels, and we try to do a needs-based analysis with these organizations because they are so big and complex, because we don't want to overwhelm them. We don't want to simplify it either. And then at the same time, we can actually talk to them about actually just making allocations, just into various funds that are here, especially in the Eureka. Are you familiar with the Eureka fund?
Tell our listeners a little bit about it.
The Eureka Fund is a hedge fund analysis organization that tracks different volatility funds, such as long tails, short vol, long vol, and relative volatility. So we try to when we go to these institutions, we sit down with them and we try to tell them that here are the basic baskets of different volatility strategies that are out there. And we go over the different nuances to them and the advantages and disadvantages and what sort of returns that they're actually looking for and what sort of balance sheet that they're willing to appoint. But we generally tell them the best way to do this is dip your toe in and to understand it. But then what we do is once they're made an allocation to a certain fund, and we generally tell them it's a small incremental investment, we work with them to understand how that will help their returns, help their overall risk profile.
Speaking of risk profile, we were talking a little bit before the show. You handed me this nice little diagram kind of showing me where a lot of the traditional players in products like SPX, which is in this graph, but I think it applies to a lot of different products out there, VIX and others, they tend to play in certain parts of the term structure. Some are playing a little bit close to the vest, a little bit close to the fire, so they're having maybe a little impact from decay and other things there. Others, like institutions and insurance companies, are playing way the heck far out. And it seems like you guys over there at Exchange Capital Resources seem to be advocating for, I guess maybe can we call it a bit of a Goldilocks style approach, where maybe taking both of those sides and moving them a little bit towards the middle? Is that a fair assessment of what you guys are up to?
That's exactly right. We actually kind of use the analogy of a beach. We say that that the world of volatility is actually like an ocean, and we have the bigger pension funds. They have all the resources to actually use scuba equipment. And then you actually have the lower tiered asset managers. They're sitting on the beach and they're up to their ankles, and you've got nothing in between. I shouldn't say nothing in between. You have small participation. And what we're trying to do is just try to work with a lot of various and second and third tier institutional and tell them there's a nice gap in here that could be filled, that you can actually create alpha and have a tremendous return as well as protecting yourself on the downside.
It does seem like that's a nice sweet spot for a lot of institutions out there. We talked about on our various programs in the past. There's a lot of data coming out of firms like OCC and others that have looked at, comparing collars and things. A lot of the data, a lot of the analysis they do is looking at, where that long leg, where the optimal place to put it is. And, if you put it too close to the front portion of the curve, you're obviously suffering from decay. If you go too far out, you're overpaying pretty much more than what you need. So it does seem like there are a lot of people out there who probably could benefit, unless they're hardcore premium sellers, which a lot of the clients you're talking to aren't. A lot of people out there who could benefit maybe from moderating their approach a little bit, maybe paying a little more to get a little bit better, or paying a little less in the case of a lot of these insurance firms that just seem to just live on this far end of the curve, almost in spite of all reason that shows them maybe they should move a little bit. So you're getting a lot of uptake to this approach. What's the response been? Yeah,
we're actually getting a lot of response and demand for a lot of information and hand-holding and a white glove approach, as we like to call it, and educating and exposing and having them gain a foothold in the volatility as an asset class. And how we're doing that is it starts with one-on-one conversations with very high-level C-level executives, just on the basics that the VIX was the shining, and I'm repeating myself again, the shining beacon of the global financial crisis. And people say, don't ever show me. And what we're getting back is right when we walk in, they say, don't show us a model that failed in 2008. And we said, that's the whole point of this conversation, is that this model didn't fail. It was actually a success. And it was very early on in the life of the VIX, so people kind of, I'm not going to say discounted it, but now it's been around for 10 years. And there are papers that bash it occasionally, and I could go into that because we do a significant amount of research. With economists, we talk to economists on every level of not only the banks but also the Federal Reserve groups, both here in the United States and also in Europe, because the VIX was actually embraced early on, right at the beginning, from the Swiss and also the French, derivatives, private banking. But there's other parts of the world that wasn't.
I used to joke about that on the SPX. Maybe you have some insight into this. Whenever we were down there and the brokers would pick up the phone, there was a 70% chance there would be a French accent on the other end of that phone. What is it about the French and these predominantly institutional products like SPX and now VIX you mentioned? There's a huge penetration over in that one particular area of Europe with these products. In all your travels and research, have you seen any reason as to why the French in particular? I mean, I was joking with Russell before about the Polish, but it really is the French who have just adopted these products en masse to a degree that I don't think anyone expected.
The French have always been very involved in complex mathematics, and if you go back even 200 years, some of the most profound theories and different formulas that were actually produced were from the French. And I'm a hardcore Bruins fan, and I was told never to try French because then people would think I was a Canadians fan. So I'd butcher any sort of French names, but there's some significant mathematical universities that focus on complex math, and there's always been an embrace towards that. On the national level, France, like I said, I work for a French bank, and the French economy lacks a good bond market. And they actually have they lean on the banks for a lot of that. There's other parts of the world that economies do that. And so how they try to leverage a lot of economic
data.
Yeah. And what they try to do is they actually use significant amount of math. It's pretty interesting.
So it's just a historical, mathematical wherewithal. That's what's driven them to embrace these products. We used to debate this all the time. We joke, oh, it's another Frenchman on the end of the phone.
It's part of their culture.
Yeah, it clearly is, because you haven't seen this penetration to any degree really in a lot of other cultures, maybe except for Poland. Maybe Russell can speak to that in a little bit. But you mentioned you're talking to all these institutional clients, getting them to migrate farther out or closer in on the term structure and a lot of these big institutional products. But interestingly enough, one of the big narratives, I think, particularly in VIX land, I know it certainly surprised the heck out of me when SIBO launched, the VIX Futures in 2004. I remember talking to them and saying, this is going to be the most institutional of institutional products ever. It's a derivative of a derivative. It's a volatility of a derivative of an already institutional product. No retail is going to touch this thing with a 10-foot pole. And lo and behold, a decade plus later, it could not have been more wrong. This thing is, it has just taken off with the retail public in a way that I don't think anybody envisioned when it was first launched. Has that surprised you? And what do you think of the traditional retail use case for VIX, which is very much focused on the short end of the curve? There's not a lot of retail out there buying even 6 months, let alone a year or two down the road. And what do you think? Has this been a good trend, or maybe are these guys getting in a little bit over their head? What do you think of this retail, rush to embrace VIX?
It's a great product, especially with the premium harvesting that you see. You see a lot of short sellers out there in the VXX. Ironically, we're on the other side. We're on the institutional side, trying to tell people that they should be buying it for the tail end. It gets people to understand that the volatility from a retail side is that they can use it from an ETF standpoint, and they can buy. But I will tell you this, which is interesting, is the VXX does not. Most banks or clearing firms will not give portfolio margin to VXX. It has to be in a Reg T account. Is because they actually, what they'll do is they want the tails covered and with unit for unit. But it is a great product. It has had great success. Not only here in the United States, in other countries have embraced it. There are VIX ETFs in other parts of the country using this VIX here.
Yeah, I think the resurgence, or maybe the explosion, probably a better word, of the VIX ETP universe has been the other, I think, surprising success of the volatility landscape. I mean, these products you mentioned, VXX, XIV, you can go on and on. Even the much maligned TYVIX, these products take off. I mean, VXX some days is the number one exchange traded product by volume out there, which I think if you had told anyone when VIX launched that not only would VIX be popular, but an ETF based on that would be a number one. It would sound like madness. So the notion of the way these products have resonated has certainly been an interesting one. It sounds like you guys have your hands full over there at Exchange Capital Resources. Before we move on from the Volatility Viewpoint segment, you kind of mentioned you guys have shifted a little bit over there at the firm. If you tell us a little bit about what you have coming up that might be of interest to our listeners, and then if listeners want to go and check out what you guys are working on, what you're doing, where should they go? What should they do?
Well, actually, we will be speaking at a couple events coming up, mostly Volatility, but I don't think it's going to be here in the United States, unfortunately. And but like I said, our client base is mostly institutional, and we really try to gear towards anyone over $50 billion. So it's a high level.
So small mom and pop retail clients is what you're saying.
No, the exact. Yeah.
That was a
sarcasm.
Joke, Mike. It's okay.
Yes.
You feel free to laugh. It wasn't a great joke, but it was a joke. And where should they go to check you guys out?
It's ecr5.com.
ECR5.com. You heard the man. All right, he's gonna be brave. He's gonna stay on and join us for the rest of the program as we get rolling into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. Like the man said, this is the portion of the show where we break down what's moving, what's shaking today and the week that was indeed in the world of all things volatility, trading, and trending and analysis. Like I mentioned, we are streaming the show live here on Friday. It is the 3rd. Hard to believe it's the 3rd of February already here. And it's been an interesting week as we look back on the week that was. And for some reason, my platform does not want to play ball with me right now. Of course, it crashes, Mike, right when I was about to load up my screens. But it has been an interesting week from an overall volatility perspective. We had non-farms actually this morning. A lot of people were waiting this week, keeping their powder dry ahead of these non-farms this week. In spite of that, it was a pretty decent volume week out there in VIX land. We'll get to the VIX options and futures in a second. But of course, VIX Cash trending south after non-farms off a full handle today. So shy of the 11 handle, which is not looking good for my crystal ball prediction. But we still got a half an hour or so left in the show. We'll see if things can rally. And of course, with vol selling off, most of the major indices up fairly substantially. The S&P up about 0.75%. The Dow up nearly a full percentage point. And tech-heavy NASDAQ, ever the laggard, only up about 0.25% or so. Since he's beaming in all the way from Poland, we'll give him pride of place. Mr. Rhodes, hopefully everything is working over there. Actually, not Poland, London now, a little bit closer to home. What caught your eye in the week that was? And if you want to give us a quick review of what the heck you were doing out there in Warsaw as well, feel free, sir.
You can hear me. I can tell you.
I can hear you, yes.
Good. Awesome. Well, nobody can tell what's been going on, and we're so smooth that people don't ever realize, how ugly the sausage can be, and that I've been scrambling to switch machines and everything over here in London. I was in Warsaw, Gdansk, and Krakow, talking to a pretty large trading group that does an awful lot with VIX calendar spreads, and they do a lot of short-term trading around shorting the front month, going long the second month. They also do a lot of trading around selling the front month, buying 2 of the second month, and shorting the third month, which actually it was pretty interesting strategy. And I've started back testing some extra things that I learned from them, and I can't wait to get off the phone with you guys and get back to the back testing, because that's what Friday nights in London are all about. We hit a single digit on the handle.
When?
When do we hit a single digit? I must have missed it. We printed a 9?
No, we did. Yeah, we printed a 9, guys.
When?
Gee whiz, am I the only person that? Yeah.
When?
FOMC.
Now, was that like a weird?
Oh, you're right. Yes,
No,
9.97. You're right. We did print a 9.
No, it was not a weird.
It was such a blip that I missed it.
I was talking to. It was a blip. It was a 15-second blip. I can't believe you guys weren't like all over that immediately.
I must have been busy on a show or doing something of importance.
I'm in the former Eastern Bloc, and I know about it.
Yeah, you're in the hotbed of all things volatility. I told you that.
Yeah, well, no, and I got a lot of questions about it, but we double checked it, and yeah, we finally got that single digit. So I almost feel like we got that off our back, and now everybody can stop worrying about it. Although you guys don't seem to, you were so worried about it, you didn't even notice it. But yeah, we printed a sub 10 VIX for the first time since Lehman Brothers was still around there, probably trading some VIX. So that, if you want to put a headline on last week, I think that's the first headline. Yeah. So with that, I'm going to keep searching for something good about weeklies to talk about and let you guys banter on.
All right, you keep looking from the volatility mecca. Look at you behind the former Iron Curtain, and still coming up with the nuggets. Well done. Mark and I over here, we're busy. We're doing stuff. We don't have time to do this in-depth tick-by-tick viewing of these things. But you're right, it did print a 9 handle, which is funny that we both missed it. So busy elsewhere. Speaking of being busy elsewhere, Mr. Greasy Meatball, what were you busy elsewhere doing, and what caught your eye this week from a volatility perspective?
Oh, so much caught my. I would say, while I was missing the VIX printing 997, I was catching that Apple implied volatility absolutely plummeting out of earnings. And Russell, I have to say, you and I called it last week when we said, everybody thinks this thing isn't going to do anything, and then every once in a while it moves 8%. And then guess what? It moved 8%. It's pretty spectacular. I'm getting some. I've been told to shush myself at work, so I got to be a little quieter. So the what I heard was what I see is just Apple vol, not only at like 2-year lows, but at like 10-year lows, and which is just insane.
It's not specific to this program, but I do a lot of work on earnings, and earnings. I'll tell you what stock price reactions to earnings and volatility have in common, and it's like a reversion to a mean with a few spikes, And when you've had a streak of kind of calm reactions. Much like when VIX is just sitting there at 11 and nobody's paying attention to it. And the next thing you know, it's in the upper teens, and then it's got a squiggly 2 handle, starting with a 20, not going all the way down to 2. But it's the same thing with earnings. And the big surprise ones are usually the ones that have had, under an average move the previous quarter. So I'm not saying it was easy to call that one, but Apple was due for a big move. Personally, I will admit when I'm wrong. Even in hindsight, my guesstimate would have been an 8% drop.
And Mike, I see you waving your hand over here in the studio. It sounds like you've been paying attention a lot to the earnings season as well. So is that what's been catching your eye this week from a volatility perspective?
Yes, we through our research, we do an extensive amount of earnings, especially within the S&P 500 and how it works within the different sectors. Because what you have is a lot of firms, especially the institutional firms that we work with. They're actually handcuffed sometimes with investing in the S&P 500, so they just move around a sector. So you have a good sector rotation. Apple, being the 800-pound gorilla in the room, is we're starting to see from a perspective that a lot of consumer discretionary companies are actually that would never be considered Apple an actual competitor is becoming a competitor. It was just about 2 years ago or maybe even 3 years ago now, that a candy maker in the Staples said, "I'm no longer competing against other candy makers for the kids market. I'm actually competing against Apple." So with just the interest.
Is that because of Candy Crush was so popular? Is that what he was going for? A little bit of a illusion there?
Well, it's just demographic trends is really changing. Everyone is all about electronics and different apps. And what you're seeing is the interest in toys and the interest in even sporting good equipment is actually starting to wane.
Yeah, it has been the earnings season, so let's just get to it now. We're going to usually get to it a little bit later, but let's dive right into it now. You touched on Apple, and Mark did as well. You touched on an option block. Yes, it is kind of the story of the week from an earnings perspective. We look a lot, Mike, on this program, obviously, at the volatility levels, the straddles, what people are pricing in ahead of their big announcements. And it seems like so far, Apple aside and a few other outliers, it's really been just a dramatic underperformance from this quarter from an earnings volatility, earnings straddle perspective. We start with Apple, of course. They closed right about 120, 135. Going in to their announcement, they were pricing in about a 3.5% move. We had commented many times on this network. I know those Mark's frequent refrain over and over again that was ridiculously cheap. And sure enough, it was. The stock blew up in the after hours, traded up as high as about 7.5%, which is probably the best performer for a straddle we saw of a major name that we saw this week. Facebook also coming off earlier this week. They were pricing in about 5%. They closed right around 133 and a quarter. They opened almost unched, so that was a pretty good sale out there. And then it traded as high as up about 1.5%. And then it traded down to the downside about 2%. So if you were a little patient in there, you got a little bit of a swing and you were well timed maybe in your gamma scalps. You could have done better than it may have seemed on the surface. Same story here actually for Amazon. Amazon, one of the other few that actually kind of approached its straddle in the after hours. They closed right around 840 last night. They were pricing in a little over $41, right around 5%. And this name sold off pretty hard in the after hours. It's the only name that even really I think it touched that boundary of the straddle right around 40 odd bucks in the after hours. It opened up off about at 807, so off about 4%, so a little bit shy of what they were pricing in. It got as low as off about 4.25. Let's see where it's trading right now. Yeah, it's higher today now, so that seems to be the low at around 804. Chipotle, the aforementioned burritos and botulism, they closed right around 424. They're pricing in about 20.5. That's about 5% as well. It seems like 5% is the level kind of across the board for this quarter as well. They opened up about nearly $10 or about 2.25%. Then they kind of swung to the downside. So another one, if you were kind of patient and had a little bit of savvy in your scalping, you could have done all right. They opened up then off about 3.3%. So the net swing was about 5%. So if you were patient, and you picked the ultimate top and the ultimate bottom, Mike, you did all right on that name. But if you were kind of just coming in looking to do some more straightforward strategy, shall we say, perhaps not so much. And the one that kind of outperformed to the downside was GoPro. They closed a little bit shy of $11 going into their number. They were pricing in about $1.25, so about 11.5%, and they sold off right about 11% going into that. So they're right about at that level or so. So any of those names you mentioned, Apple, Mike. Any of those other names in particular that's really catching your eye that you've been watching this cycle?
Amazon, and actually Weyerhaeuser was actually kind of an interesting one too today. We really try to follow the volatility, the financial volatility because of just a lot of things, all things Deutsche Bank. There's been a lot of news out of Deutsche Bank, so we just think that there could be some tail risk involved in that. So we've been really monitoring that situation there.
Tail risk with Deutsche Bank? I don't see what you're talking about, sir. No way possible could that possibly be. Russell, I know you like to follow all things earnings. You get really excited. You usually get excited around various things, but earnings season seems to hold a special place in your heart. So what amongst all those names I listed, or maybe there's a more esoteric name that you're following that I didn't list there, but what caught your eye this week from an earnings vol perspective? And do you also agree with that narrative that I've kind of slapped on earnings season that has kind of been a dramatic underperformance so far with a few outliers accepted?
What was the term that Bill Luby used last week with respect to the honesty that we're supposed to get from companies at the end of each year? Because there's a little bit more repercussions if you're not 100% honest with your year-end earnings. I forgot what his term was. It was great, and I should have written it down. That's the amazing part of this earnings season. Not just that we haven't, to me at least, not just that we haven't had a whole lot of outliers relative to the straddles, as you put it, but we haven't had any real disasters that I'm aware of. again, you have to give me a little bit of a mulligan because I'm far, far away. But, I think, so far so good with respect to earnings. We've got about 60 or so companies with weeklies that report next week. So we're not quite done with it. But, I'm going through the list while you guys are talking. I don't see a whole lot of well, here's a good one. Twitter reports next week. Last quarter, the stock rose 0.64% off of earnings. The average move is 12.5%. It's dropped as much as 24 and risen as much as 20. So let's keep an eye on that one for next week, Thursday before the open.
Speaking of keeping an eye on things, by the way, keep an eye on Russell's Twitter. He just tweeted a glorious photo of himself from London. You check it out, listeners. We've retweeted it for your listening or viewing pleasure, I should say. So keep an eye on that one. It will shock you awake if you've had if you're still a little drowsy coming back from lunch, maybe here in the middle of the session. And speaking of the session, we also like to look at all things VIX. Like I mentioned, VIX Cash trending off here towards the second half of the show here. Also out there, VIX, like I said, VIX Cash pretty shy. VVIX is still hovering in levels that aren't really, I wouldn't say catastrophic. It was right around the high 80s earlier today. Still around 88 right now. So again, well off that those recent high levels where we saw it flirting with about 120, 121 back in November. I'm not sure what could possibly have happened in November that would have caused a spike in VVIX. But that said, a little bit off those recent lofty levels, but not as low as like the mid to low 70s where it seems to bottom out a lot these days. Looking out at the VIX Futures, also the premiums out there in terms of to cash getting a little bit narrower these days, as you expect with the front month, but also with the second month going on out there as well. About a point and a quarter or so right now between the front month and the cash, and the 2 months out about 2.5, 2.6 or so. Mike, you mentioned a lot of different products you guys watch. You pay a lot of attention to the VIX Futures out there, and is the VIX Futures term structure something you sit down and really discuss with a lot of these big funds when you're out there preaching the gospel of options and volatility, or is that kind of a little too overwhelming for them? Maybe you wait for the second date, the second meeting before you bring that up.
No, that is something that we talk about. We talk about the relationships because it's a little bit different. Because you have month-to-month relationships, unlike the S&P 500 index, where it's just quarterly. And we want to talk about term structure because that is a great indicator of the future volatility outlook, and trying to tell them that this is because you're a big company, because you actually have assets under management, you have a pension fund, you have different – how do you protect that? And the outlook is here, but at the same time, you have a lot of unknown unknowns in where what we call probability of ruin. There's a great article out from Mike Edelson. He's the chief risk officer for the University of Chicago's endowment fund. And he embraces volatility as, I think it's like a $13 billion endowment. And he really talks about embracing the idea that there is a probability of ruin, and you always have to protect the tails. So even though there might not be an outlook, you can actually play in there and actually gain some alpha, while at the same time actually protecting for that, to lower the probability of ruin for your endowment, because that is a real.
I think if you knock on the door of an endowment or pension fund and say, hey, I'm going to lower your probability of ruin, I think they might at least let you in the door, I would think. That's probably a good opening line that you could have there with them. So maybe you should rock that one going forward. Speaking of rocking, it's time for Russell's Rockin' Tune. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
This brings a smile to my face every time we hear it. Of course, time for Russell's Weekly Rundown, the time where, regardless of where he is in the world or what time zone or what ridiculous hats he is wearing, he spends at least 25 minutes regaling us with the deep intricacies and minutia of all things going up in the VIX weekly options this week. So have at it, sir. 20, 25 minutes should be good.
You know how badly I'm scrambling over here right now. You know what? The best thing I can tell you with respect to the weeklies is actually somebody that bought they bought the February 8th 1150 puts, worked their way up to about a 1,200 contract position, paying anywhere from 10 to 30 cents over the last couple of weeks. It looks like they're selling those things for 20 cents right now, as VIX, the VIX is down at 11, and the February future is, or the February 8th future is working. Is only at it's 1175 by 1190 right now. So somebody had been buying those puts, which I thought was kind of an interesting move going into, and I think I mentioned it about a week ago, which I thought was an interesting move when we had the FOMC, and we see what the FOMC did to VIX. It made it go below 10. And then we got an employment number, and that's not doing any favors for VIX either. So the best thing is an exiting trade. Next week, the following week, February 15th, well, that's standard expiration, and I'm not allowed to talk about that at this moment. And then if you move onward, the open interest for the February 22nd is only, about 15,000 contracts or so. So there really hasn't, and I don't think there's a whole lot to position for between now and the 22nd. We've kind of gotten through at least the news for at least early February. So I'm going to steal something that I saw on Twitter while I was working here, which I just thought was a great quote. If I were not in London, I would be at the Latin American CFA conference in Cancun. What was I thinking? I was invited to both, and I chose to come out here, I guess because I wanted to buy a cool hat. But apparently somebody was just doing a overall kind of like an overview presentation of the U.S. markets, and he said it's amazing that VIX is under 12 because Trump ain't no VIX under 12 president. I like that.
I can see a certain amount of logic to that, even if I don't see the logic of that hat, sir. But that's a conversation for another day. Moving on to the big mothership VIX options. It was an interesting week, if not the heaviest of volume weeks. There were some sparks of life, even though today wasn't really one of them. Non-farms didn't drive, at least so far, hasn't driven a heck of a lot of paper. VIX has been averaging right around 590,000. So that ADV is creeping back up towards that 600,000 level, which is a sign that VIX volume may be returning back to some normal levels. You remember last year, listeners, it was kind of trending down for the second half of 2016. We ended up with a pretty anemic ADV by the end of the year. So trending up, that's a good sign. Today, only about 365,000 contracts going up so far. So maybe today won't be the rock'em sock'em day some people were hoping for. The rest of the week was, yesterday was kind of quiet as well, 327. Earlier in the week, though, had a little bit more action. About 550 going up on Wednesday, 442 on Tuesday, and about almost 750 going up on Monday, that being the active day of the week. About 3-to-1 calls over puts out there. So getting a little bit more call heavy, but still nothing worthy of note out there in VIX land, which can get far more call crazy than that on any given week or month. And speaking of weeks, what was lighting it up this week? What were the hot top 10 VIX strikes out there? Well, it's pretty much a Feb call strip with lone puts. Actually, no, 2 puts. I take that back. And a handful of Marches, and even an April getting in there. So started off number 1 still this week, flirting ever so close to that 400,000 contract mark. Just a tick underneath it are the Feb 21s, followed hot on their heels with the Feb 17s with about 369,000 contracts open. Then the Feb 22s, again, that Feb call strip, very popular, listeners. Drops off a cliff, though, about 264,000 contracts open, so about 100,000 less here for the number 3 spot. Number 4, the Feb 20s, 227,000 contracts open there. Number 5, the Feb 16s, a little less optimistic Feb 16s, a little more straightforward, 217,000 contracts. Number 6, though, we go all the way out to April. And the April 20s with about 200,000 contracts open. Number 7, these are the only puts here. Actually, no, I take that back. There's one other. The Feb 12 half puts with about 184,000. So the lone put, which is surprising given the trend we've seen in VIX over the past week. I mean, Russell was mentioning some weekly puts lighting it up. Surprising there aren't more puts lighting up this top 10 here this week. Number 8, the Feb 30s. You can't get rid of these things. 161,000 contracts open there. Number 9, the March 24s, 160,000. Number 10, the second put on our list, the March 15 put. So again, a little bit of March love out there. Total of nearly 8 million contracts open, about 5 5.8 or so on the puts and about 2.05 on the calls and about 2.05 million on the puts. Mike, really quick, we asked this of all our guests. I forgot to ask it to you earlier. I mentioned the Feb 30 calls being one of our hot top 10 VIX strikes. Every week we talk about these top 10 strikes, and like the 30 strike is always up there. It doesn't matter what the month is, doesn't matter where VIX is right now. VIX flirted with the single digits, and it doesn't matter. The 30s are still lighting it up. What is maybe you guys need to do some work on that with the strike selection? But what is the magnetism? What is the attraction to this 30 strike that month after month, week after week, there is still a size open interest, size trading out here on the 30s, almost regardless of what else is going on in the marketplace? What is the fascination with this strike?
I think it's actually percentage-wise, and it's the percentage of complete fear is when people know that any one day they can wake up and the market can be down quite a bit. And where do they get comfort? They get comfort on the 30 line, because that's ultimately what we try to tell a lot of these institutions is that you want to cover your tails. They think when they do their needs analysis and they see when were we hurt the most, or when were we hurting and we were starting to see crying uncle, we were seeing they do it with their quants. They see it at, the VIX was near 30. That's where that's where the fear starts to run.
We've often debated on the show just what that breaking point is out there in VIX. Some people say, obviously, it depends on your risk tolerance, your position. Some people say 35, some say 40. But clearly, the institutions have spoken. And clearly, I think you're right. It is 30. That were some quants, or maybe a legion of them out there, some actuaries have done the work and said, you know what? You're right. 30 is the point where this far and no farther. We have to hedge here. And so maybe they're seeing this now as a great time to load up on all the 30s because they're crazy cheap. Either way, that strike continues to fascinate many out there. Speaking of fascinating, I'm not sure if we can describe him as that, but nonetheless, he saw some fascinating options activity. Mark, I know you've been watching the VIX options this week, including a size call spread. What caught your eye out there this week?
Yeah, there was a couple of trades that were really interesting. The biggest, and this is the one everyone was talking about, yesterday after 3 o'clock, 4 o'clock Eastern, for all you East Coast people that don't know how to convert time. A trader stepped in and he sold 135,000 of the April 20s, and he bought 135,000 of the March 17s in what was a curve trade. Completely moved things around. And then from there, we've also saw a pretty big trade go up. Today, a customer did the April 14-15 1x2. Another, actually kind of opposite of the other guy, a customer bought a chunk of the April 20s for 119 tied up to quarter stock today, about 12,000 of those. So lots of trading today. Lots of stuff moving around.
Mark, was that a traditional 1x2 like we always seen, selling one, buying two, or were they going crazy the other way?
They sold two and bought one.
Really? Interesting.
To the crowd. Yeah, and got paid 65 cents on that put. That was a put 1x2. But the big one was that huge spread. I had a lot of people asking me, "What's the deal with that big spread? Why are people buying that spread?" And I looked. And Russell, stop me, or if I'm tells outside of school, I said, well, when I look at March vol at around 81.5 or 82, and I look at April vol around 78, and then I look at the spread between March and April of about $1.10, and they're less than a month apart, I see that as a curve trade and a vol trade, and that April might be a little expensive, and the future's a little steep, and March might be a little cheap, and the future's a little low. So it's kind of the old, it's kind of like one of the old earnings plays where you get short a bunch of Vega but get long Gamma, and that's what this guy was trying to do, and he did so because it appears he views the curve as a little mispriced and the volatility is a little mispriced.
The if you take the average VIX by month going back to 2007, April is either 11th or 12th. It's one of the low ones. So I wonder if they're taking a look at that. They think that premium's too expensive based on history.
Which I do.
You know what I mean? it just looks expensive anyway. But then if you throw history in there, and April's always been perplexing to me with respect to its behavior. I've never come up with a good reason for it.
Yeah, Russell, look at this. So the March expires on the 22nd right now, and its vol is 81.5, and the future's 13.9. April, which expires on the 19th of April, so 27 days later, 15.25 with a vol of 78. There's something off there with the way term structure is there. And so that's kind of what I view it and why I think that that guy executed that trade.
Mm-hmm.
It was the 21s, not the 20s. I'm sorry. It was the 17-21.
21s, yeah. Mike, I know you're watching this one as well. What are your thoughts here on this size calendar going up here?
Well, earnings season will be well and done, and you when is Easter? I mean, remember there used to be some Good Friday
Easter premium, eh?
Yeah, Good Friday premium plays.
I know Cadbury eggs do have a nice premium to them around that time of year, so maybe that's
you have
being
that
factored in.
You have that Friday off, so a lot of times that long weekend throws off. But it still doesn't. You're right. I possibly see it like Russell said. April tends to be one of the lower in the vol season, the lowest in the vol season, and the seasonality of volatility.
Yeah, definitely a curve play. Meanwhile, we have to keep on rolling into our final segment. Fortunately, no time for questions, listeners. We'll get you next week, don't worry. But we got to keep on rolling into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, it was another one of those days where VIX had a little bit of a nice range, and for a while there I was looking pretty good with my 11.5 prediction. Who knows, by the end of the day, it may come to pass yet again, but right now is when we were predicting, and the greasy meatball sneaking in a victory there finally. Well done, sir. You were predicting 11.05. Right now is actually exactly at 11.00, so pretty close there. Not bad. 11.5. Mr. Russell still the degenerate volatility buyer that he remains to be. He was pushing 12.99. Bill Luby also on the upside. We were all pretty close last week, though, all of us sane ones, except for Russell. We were all on the 11 handle. Bill was 11.78. So, Greasy Meatball, you actually take one. Well done, sir. I'll let you have the pride of place of going first. What are you feeling for VIX Cash this time next week, sir?
Let's look out ahead. We don't have a lot going on next week. A little bit more earnings. And if you look at the way they're trading volume, I'm going to say, and we've already touched 997. I'm going to go 1092.
1092. I guess Russell doesn't agree. He's offended. He coughs right over your prediction. But 1092. Oddly precise, but interesting. We shall see. Of course, 11.05 worked out. If you want even numbers last week, you would have won exactly this week. Mike, you're our guest. I'll give you second pride of place here. This is obviously the game where we attempt to defy the volatility gods and predict what VIX Cash is going to be at this exact moment, the end of the show next week. Right now, it's right about an 11 handle. Like we said, there's some funky things going on in the world right now. But what are you feeling for this time next week, sir?
It's kind of quiet, like everyone said. And since the jobs numbers are back out and people have to digest it, I'm going to go at 11.34.
11.34. So everyone's still staying in the 11 handle. We'll see if Mr. Rhodes, I'm guessing he's going to be somewhere in the stratosphere. Like he said Trump ain't a single-digit VIX president. Mr. Rhodes, what are you feeling out there from the volatility mecca of Poland by way of London, sir?
$1.
This is not Price is Right, sir. Try again.
Oh, crap. All right. I'm going to go 12.01. Because Trump is not a sub-12 VIX president.
I can see a certain logic. This is why I hate going last, because the spots are all over the place. Then I have to kind of slot in, play the good host here. I usually like going first. But Mr. Reese Meatball won, so he earned that honor this week. I won first a lot last year. I can't be first every week. Let's see. So we got a 1092 range to a 12.01. I'm not feeling the vol surprise that Russell is. I think there's not a lot on the horizon. We already got our non-farms. We already got our Fed dance. We already got most of our sizable earnings. We did flirt with single digit this week. I'm gonna go south of the meatball here. I'm gonna say I don't know. I'm not gonna go single digits, but I'm gonna say I like nice even. I'm gonna go 10.5. So there we go. 10.5 on the downside, listeners. 12 on the upside. Nice range with a little bit of wiggle room in the middle, as we like to do here on the old Volatility Views program. All right, that music means we've come to the end of yet another epic sojourn through the world of Volatility Views. Really quickly, let's go around the horn again one last time, checking with my cohorts here on the old panel. See what's cooking with them. Mike, we kind of hit on the top of the show, but if listeners are interested in what you guys are working on over there at Exchange Capital Resources, where should they go? What should they do? And what do you guys have coming up down the road that may interest them?
We're like I said, we're doing a road trip over in Asia, actually, believe it or not, coming up in a couple months. So any of those Asian listeners, reach out to www.ecr.com, ecr5.com, and we'll make sure we can meet up with you.
ecr5.com to learn more. And since you're beaming in, you're nice enough to beam in all the way from Warsaw/London, Mr. formerly Corner Office, now Corner Hotel Room. What's coming up in the land of all things CBOE and CBOE Live Vol?
God, I was going to call myself the Greasy Traveler. I'll be back.
Judging by that picture, I may agree with that.
Yeah. I'll be back. Well, somebody stole all my toiletries going through security. I had to grab my dock kit. I haven't been able to shave in 3 days, and boy, do I smell good. Seriously, this has been an adventure. We've got to do a segment next week on this trip because it has been a trip. I'm going to be back home. Going to start planning out a few things over the next few months for the Institute. We're going to do another VIX class. We're going to do an income trading class. And then in a week and a half, I'm going to Mexico. Going to an academic conference. Going to Mexico for an academic conference in Mexico City.
Bring your toiletries with you on that one, sir. It's a helpful thing I find on these international trips. And last but not least, Mr. Greasy Meatball, what's cooking in the land of Carmen Line and indeed Option Pit?
Lots of stuff. I'm looking forward to helping Russell with his VIX class when they do it at the Institute. And I just read our blog every day. We post lots of fun stuff on there, optionpit.com/blog.
There you go, optionpit.com/blog to learn more. And on behalf of the Greasy Meatball and the traveling Dr. VIX and Mike from Exchange Capital Resources, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. Remember, those of you in the live chat, stick around, go get a beverage, take a nice bathroom break, come back at 1:30. If you like commodity vol, didn't have a chance to get into it much today, but we're going to do a deep dive into all things futures, options, volatility, skew, all that fun stuff on TWIFO, This Week in Futures Options, coming up at 1:30. So stay tuned for that, and we'll see you Volatility Views listeners next week for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.